Hello, good morning and welcome. You've tuned into ET Now and you're watching Buy Now, Sell Now with me, Varun Hiremat, and along with me, Karunya Rao. Let's take a look at the markets this morning. The banking index is just a star performer. Look at SBI, 13% up in trade, 400 rupees last traded price, and targets are on an average consensus at least 525. So looks like this one's primed to take off even from here on out. Kotak Bank making a strong comeback today, up nearly 5% and once again flirting with that 2,000 rupee per share mark. ITC as well making a comeback today at 236, NTPC up 2.5% at 102, and Tata Steel at 667. Those are your top performers and some decent market bet. We've recovered slightly in the last couple minutes. But let's switch gears to an all-important management who's joining us. Zee's Rohit Gupta is now with us and he's the Chief Financial Officer at Zee. Thank you, sir, for joining us this morning. It'll be great to get perspective from you as to what exactly transpired in the quarter gone by. So, first off, let's begin on a good note. There's been a positive earnings surprise. What led to this?
Yeah, thank you. So, let me start with the highlights first. So, let me start by saying that, during the quarter, we have built on recovery that we saw in the previous quarters, and now our businesses return to normalcy. We've also seen that our viewership share is now returned to pre-COVID levels and stands at 18.2%. Advertising has seen a sharp rebound as all the sale of products across all categories have seen strong recovery. In Z5, we continue to augment our user base on the back of strong original content and digital consumption in the country. And our global MAUs have grown by 21% quarter-on-quarter to 65.9 million. During the quarter, we have also witnessed year-on-year growth across all businesses as well as revenue streams. Our total revenues have increased by 33% year-on-year. And here, ad revenues have grown by 5.8%, which has dropped by 45% year-on-year in the H1 FY21 due to pandemic. Our domestic subscription revenues have grown by 9% year-on-year on a like-to-like basis, driven both by television and digital business. We have in our other revenues a spike. This is on the back of sale of content in the international business. So, on the back of all the strong recovery in revenues, we've seen a sharp jump in our profitability, and our EBITDA for the quarter has increased by 26.5% year-on-year to 7.15 billion. Our balance sheet remains healthy, and our cash and cash equivalents have increased to 18.2 billion. So this said, the momentum for economic recovery remains strong. Our underlying trends are encouraging, and we think that this will help us in returning to the historical growth trajectory in the coming year.
Right, so Mr. Gupta, thank you for highlighting the key factors that played out this quarter. But now coming to sustainability, firstly on the ad growth front, is what's happening currently sustainable? Secondly, on subscription revenue, what's the outlook going forward?
So, yes, we believe this ad, growth is sustainable, and we believe that this, the new budget, there is going to be an increase in the spending, and we will further see. Like I said, we are expecting the historical growth trajectory to return in the coming years. As far as subscription is concerned, while our growth is 9%, driven by both digital and television business, we would have seen higher had the NTO 2.0 been announced. So our growth of television subscription revenues for the year has been impacted as we are not able to do the price hike due to the status quo which has been caused by the pending judgment. In a stable policy environment, our subscription revenues can grow in low to mid term.
Right, Mr. Gupta, and talking about your margins and cost optimization, is that going to carry forward into Q4 of this year? And then what will the impact be on margins?
Yes, we have seen the result of cost optimization. As I said, our overall EBITDA have increased by 26.5%. I must mention here that, our EBITDA margin was impacted by the, one-time spike in the other revenues because of the sale of content business in international markets. If I adjust for that, our actual underlying margin is 29.3%. However, we continue to invest, into content, and in the coming year, we will see a hike in the investments in the financial year FY22. We think that this will impact our margins, working capital, and cash generation in FY22. I will be able to give you a more granular guidance when we do our Q4 results.
Right, Mr. Gupta, thank you so much for taking out the time and talking to ET Now today. It was great to get perspective from you. On that note, let's slip into a quick break and buy now, sell now. Stay tuned. We'll be back in just a minute.
Welcome back. You're still watching Buy Now, Sell Now. Let's touch base with the management of Stove Kraft. They made a debut on Dalal Street today and listed at a 29% premium over issue price. So yes, let's welcome in Rajendra Gandhi, the CMD of Stove Kraft. Mr. Gandhi, congratulations on a good listing. Tell us, what is it that gives Stove Kraft an edge over its peers? What is the company doing to keep up with the changing consumer trends?
The company's objective was always to ensure that the consumer is happy, the customer is happy, and this has led to tremendous influence in the minds of the consumer, and more consumers have flocked to the brands that the company offers, and that is now led to where it has come to a stage of listing. And because more and more consumers are opting for our brands, the way they are positioned, the company is able to deliver the kind of value the consumer is expecting, and because of which it is ultimately leading to gains at both the consumers and at the investors end, because of the size and scale that offers, the opportunity that is the country is offering. I can say we are in a privileged world today to be in this part of the world, which is growing at the fastest pace, more particularly in the space that the company operates in. It is to do with the kitchen and home, and more and more this category is growing at a pace which I don't think is paralleled by any other consumer offering.
You've seen good growth in the first half of this fiscal. How do you think the demand is likely to shape up going forward, and do you also believe it's a temporary boost or a permanent trend that we're witnessing in consumption?
Yeah, the company has been growing at a healthy pace, and more so post-COVID, the way the consumer is behaving, and the way people are now dining more at home. More and more people have started celebrating cooking. Of course, we are seeing very high traction in our various, the offerings that the company has. Very soon, of course, quarter on quarter, you will see our results coming out, and I'm sure it'll make the investors happy.
Right, so hi, this is Varun Hiremat also joining into the conversation. Kitchen appliances have seen a very good demand during the pandemic as people spend more time at home. So how is the recovery shaping up for the company, and is high demand starting to taper off, or does it look robust?
On the contrary, I can say that we are experiencing very high traction in all the offerings that the company has, the various products that are used both in the kitchen and the home. We are seeing very high traction. So we don't take the theory of this demand tapering down. More particularly with Stove Kraft, we are seeing very high traction in the various products that we make.
Right, and commodity prices are up, and aluminum, steel, and packaging material have all seen significant cost increase recently. So, what is the expected impact on your profitability and margins as the prices of these raw materials go up?
We offer our products at the most, I can say, we put our best efforts to offer the consumer the best value for what he is paying, and we'll always continue to be there. But if there is any impact on our cost, obviously we will want to pass it on to the consumer. Only to the extent of the price increase, we are able to pass on this price in a reasonable time. So I don't see any change in our margins, in spite of there being some pressures on commodity prices for the time being.
Any price hikes in the near term, given that the raw material costs are going up? And if you could also tell us to what extent are you sort of penciling in a price hike in the coming couple of months?
So yeah, because as I mentioned, we ensure that the consumer gets the best value, and so it's not that we would want to make an advantage of the situation, but we definitely have passed on the price increase. It's not now, it's beginning of the quarter. We already passed on the price increase, and fortunately I can only share with you that there is no change in demand situation.
So Gandhi, if you could tell us what is the expectation of growth from here on, and even in market share expansion, given the shift from unorganized to organized players, what's the benefit seen?
The company has been growing, has experienced a healthy growth in the brand offerings of the company. While in the past we would have recalibrated our business towards a brand business. We are seeing higher growth than the past, and as I already mentioned, there is high traction in the category. We believe that there has been a shift in the way the consumers have started enjoying or celebrating cooking, more and more people dining at home, and this has actually increased the opportunity for us, and so is the growth of the company also.
All right, Mr. Gandhi, we'll let you go on that note. Thank you once again for joining us, and the stock trading at 455 as we speak.
Hi, welcome back to Buy Now, Sell Now. We're still catching up with managements for various reasons, and particularly to discuss their results. We're now joined by a very special management, Dr. R. Anantha Narayanan, who is the MD and CEO at Strides Pharma, is now with us. Good morning, sir. Thank you for taking out the time to talk to us at ET Now. It'll be great to get perspective from you on what transpired this quarter. So let's begin with that. Could you talk about how the quarter played out, specifically considering now that it's been 9 months post the top management changes? Where is the company headed?
So let me start off with the very first beginning with the new management and my own coming into Strides and the whole journey. So when we started off the financial year, when I took over from Arun after the transition of the first 3 months, which was the Jan, Feb, and March, we started off the quarter with the unfortunate event, which was the withdrawal of ranitidine that we had to do in the market in the US based on the US FDA notification. And as you know, ranitidine was one of the very important as well as big revenue products for us in the US. Simultaneously, we were also hit, as everyone else over the countries with COVID. So it couldn't have been a more challenging time, but also an opportune time to get in and look at the business. And we've actually grown the business from almost going down post the withdrawal of ranitidine. And then
Okay, that was, of course, Strides Management talking about some of the latest developments at the company. I think it's time to take a break actually and bring up the BNSN quiz question and answer. Okay, sorry. We're actually joined by the management again. Great to reconnect with you, sir. So what we were saying was earlier on the company was going to invest in a particular business. Have they, and now that those plans have been shelved, why are you still raising capital?
yes, the investment required is much higher than we originally envisaged, and the gestation period is longer because this is clearly a CDMO business platform that Stelis Biopharma will focus on. And given the long time that is needed, we did not want on the strategic review, Strides defocus from the growth of its core business. And also clearly do not want to create a drag on the balance sheet of Strides, hence this decision.
Okay. Earlier, the company was going to invest in that business. Then why now raise the capital?
No, the marketing expenses in this kind of business that we have there's no increase in marketing expenses. It's pretty much where we are and where we need to be. So there's no, we don't see any adverse impact on marketing expenses.
All right, Mr. Ananthanarayan, thank you so much for joining us and for telling us about your performance and what to expect going forward as well. With that, we're completely timed out on the show. Wrapping it up. Thank you for watching.